This week in crypto has been defined by two headlines that change the way the world sees digital assets. The Federal Reserve has officially shut down its so-called Novel Activities Program, the special framework created to put banks' crypto dealings under a microscope. Instead of treating crypto like an outsider, the Fed has folded it into mainstream supervision. In simple terms, the message is clear. Crypto is no longer an experiment. It is part of the financial system. At the very same time, BlackRock, the world's largest asset manager, has revealed its crypto holdings have surpassed $100 billion, with Bitcoin dominating the portfolio. That's not a trade. That's not a punt on short-term momentum. That is a structural allocation from the most risk-conscious manager on Earth, a signal that digital assets are here to stay. Meanwhile, Bitcoin itself is nearing a historic milestone, almost 100 days trading above $100,000. Ethereum's spot ETFs saw their first significant pullback in weeks, with $59 million in outflows breaking a $3.7 billion inflow streak, even as BlackRock quietly added more to its Ethereum positions. And XRP, despite slipping about 3% on the week to hold near $3.14, showed resilience as whales defended the key $3 level. Analysts continue to eye the $4 to $5 range if momentum returns. So the big picture is clear. Washington and Wall Street are both leaning in. The Fed is normalizing crypto. BlackRock is allocating to crypto. Bitcoin is proving its staying power at six-figure levels. Ethereum is in the spotlight with ETF flows. And XRP continues to fight for upside in the face of macro headwinds. Now let's break it down coin by coin because the top 10 tokens all told their own story this week. Bitcoin finished the week around $117,775, dipping from highs of about $119,200 and holding support near $116,900. Despite the pullback, Bitcoin has now spent nearly 100 straight days above the six-figure threshold. Analysts say that milestone matters more than any single candle. It shows institutional resilience and a new psychological floor for the market. The Fed's normalization announcement and BlackRock's position are reinforcing the idea that Bitcoin is no longer speculative, it's structural. Ethereum traded at about $4,450, with highs near $4,663 and lows around $4,379. The biggest story wasn't just the price, but the flows. After 8 straight days of inflows totaling over $3.7 billion, spot Ethereum ETFs finally posted $59 million in outflows. Some see this as healthy profit-taking after a huge run. Others argue it signals fatigue. But with BlackRock adding hundreds of millions more in Ethereum exposure, the bullish thesis remains alive. BNB hovered near $825, down from a high of $853, and finding support around $813. Price action was mostly muted, but regulatory developments in Europe matter here. Bybit EU launched a MiCA-compliant launch pool, showing how exchanges are pivoting toward fully regulated environments. That trend gives BNB indirect support, even as competition heats up. XRP closed the week near $3.10, slipping about 3% from highs of $3.30. Every test of $3 was met with heavy volume, suggesting whales are defending that line. Analysts suggest a breakout above $3.30 could set up a run toward $4, while more bullish outlooks see $5 in play if Bitcoin breaks higher. The cautious side warns macro shocks could drag it back under $3, but so far the support has held strong. Cardano stood out this week, climbing to 94 cents and even breaking the $1 mark briefly, its highest level in 5 months. Analysts credited strong retail flows and rotation out of Bitcoin into altcoins. ADA gained more than 10% at the peak of the week, though it cooled into the weekend. If ADA holds above 90 cents, many expect renewed attempts at a sustained dollar breakout. Solana traded around $186, slipping from highs near $198. Volatility was driven by a spike in Tether minting and options expiries that shook short-term traders. Still, Solana remains one of the strongest performers of the year, with institutional flows keeping it firmly in the top tier. As long as it holds the 180 range, analysts are targeting 200 plus in the near term. Dogecoin finished near 22.5 cents, with highs at 23.2 and lows around 21.8. While not spectacular, Dogecoin's stability is noteworthy given the broader market chop. Some analysts argue Doge is quietly building a base for another leg higher, though the catalyst is likely tied to broader meme coin sentiment rather than fundamentals. Polkadot slipped to $3.89 from highs of $4.10 and lows near $3.84. DOT's lack of big moves highlights a rotation into larger alts, though analysts note development activity remains steady. If the altcoin rotation continues, DOT could be one of the beneficiaries after lagging in recent months. Polygon ended near 23 cents, with intraday highs of 24 cents and lows around 22. Like Polkadot, it lagged compared to ADA and Sol, but it remains part of the diversification trend retail investors are following. Analysts say sustained closes above 25 cents would be the first real bullish signal here. Avalanche wrapped up at $24, with highs of $25.50 and lows of $23.29. AVAX didn't grab headlines but held steady, buoyed by ongoing institutional interest in tokenization projects running on its network. Analysts say as long as it holds above 23, it remains in a strong accumulation zone. So across the top 10 coins, the story is mixed. Bitcoin is proving its six-figure base. Ethereum is testing ETF demand. XRP is fighting at $3. Cardano is breaking higher. Solana is pushing back toward 200. Meanwhile, altcoins like DOT, MA, and AVAX are lagging but showing accumulation signs. And all of this is happening in the same week that the Fed pulled crypto into the mainstream and BlackRock crossed $100 billion in exposure. Prices may look sideways on the surface, but the structural picture has never looked more bullish. What really set the tone this week wasn't only price action. It was the kind of news that changes how institutions behave. By shutting down the Novel Activities Program and absorbing crypto into ordinary bank supervision, the Fed essentially told every risk committee in America, if you want to custody digital assets, pilot tokenized deposits, or settle cross-border flows with regulated stablecoins, you will be examined the same way you are for everything else. That matters, because banks don't move on tweets or narratives, they move on frameworks. A separate supervisory bucket kept crypto in a penalty box. Bringing it into the core manual says the referee is willing to call the same game for everyone. It doesn't make crypto risk-free, it makes it governable. And when something becomes governable, big institutions budget for it, staff for it, and eventually launch real products around it. Now put that alongside BlackRock crossing the $100 billion threshold in digital assets. BlackRock is not a momentum trader, it is a benchmark setter. Its iShares products gave conservative capital a compliant wrapper to own Bitcoin and Ethereum. That did two things at once. It pulled new demand into the underlying coins, and it gave CIOs a way to explain crypto exposure to investment committees that still think in terms of style boxes and tracking error. When there's an ETF with tight spreads, daily creations and redemptions, a Big Four auditor, a top-tier custodian, and a ticker your OMS already supports, the friction that once killed the conversation isn't there anymore. The conversation becomes about sizing, not permission. The equity market is validating a second front for crypto, cash-flowing businesses that live in this ecosystem. Circle's public listing in June, the blowout open for bullish, and the momentum behind exchanges and infrastructure providers lining up filings make one thing clear. Wall Street doesn't just want coin exposure. It wants revenue exposure to the picks and shovels layer. That attracts a different kind of investor. Funds that can't hold tokens by mandate but can absolutely hold a regulated company with audited financials and an investor relations team. If you're thinking about the adoption curve, this is how you expand the pie without forcing every player to change their prospectus. Ethereum's spot ETFs gave us a good temperature check on that appetite. After 8 straight sessions of strong inflows, we finally saw a modest outflow this week. Call it healthy profit-taking after a big run. The more important point is that the mechanism works. You had billions in cumulative inflows, a little cooling, and no drama. That's routine price discovery in a product category skeptics once said was impossible. And while some funds saw redemptions, others continued to accumulate, which tells you the investor base is diversifying. Fast money players exiting after a pop, while slower, mandate-driven capital keeps building a core position. If you pull the camera back, you can start to see how these pieces fit. Regulators remove the scarlet letter from banks that touch crypto. The largest asset manager on Earth scales its exposure into the triple-digit billions. Public markets reward crypto-native businesses with strong listings. ETF vehicles give mainstream capital a simple on-ramp. And the coins themselves trade like they've graduated from a retail mania to an institutional asset class. Still volatile, still capable of sharp moves, but now with depth, redundancy, and a bench of buyers who aren't glued to a one-minute chart. So where does that leave us heading into the new week? Watch three things. First, watch banks. If you start to see name-brand institutions restart custody announcements, pilot tokenized cash programs, or partner with established crypto infrastructure providers, that's the Fed's decision translating into action. Second, watch ETF flow data. One day doesn't make a trend, but sequences do. A return to steady inflows on Ethereum after a pause, paired with continued strength in Bitcoin products, would tell you allocation programs are still running. Third, watch leadership. If Bitcoin's almost 100 days above 100,000 turns into well past 100 days, that becomes the line every strategist cites in client notes. The longer we base at 6 figures, the more it looks like a new regime rather than a lucky streak. And that brings us to the close of this week's Crypto Roundup. We saw Bitcoin hold steady above 116,000, keeping its historic streak alive. Ethereum cooled after a huge ETF inflow run, but remains firmly in the institutional spotlight. XRP defended the $3 line with whales stepping in, while Cardano and Solana gave us flashes of strength that kept altcoin traders engaged. Meanwhile, Polkadot, Polygon, and Avalanche reminded us that not every project needs fireworks to keep building momentum in the background. Beyond prices, the bigger story is the system itself changing. The Federal Reserve pulled crypto into the mainstream by ending its separate oversight program. BlackRock made a $100 billion statement that digital assets are not a sideshow, but a structural part of global portfolios. Public markets welcome more crypto companies. And ETF flows, for all their volatility, prove that crypto now has deep, durable channels for capital. The themes are converging: regulation, adoption, and resilience. Each week, the question shifts further from whether crypto belongs to how quickly the rest of the financial system will adapt to it. The rails are being laid, the capital's committed, and the headlines are catching up with what long-term holders already know. This industry isn't going anywhere. That's all for this week. Like and follow, and we will see you at the top.